Alrighty, so the nature of the thing, and I'm going to honor this also on the online class, is you guys have got a holiday next week, next Monday. In fact, some people are even taking tomorrow as well. So anyway, but what we're going to do is we're going to talk about this tax strategy. There's way more to taxes than we can cover in less than an hour. So I'm not necessarily going to attempt to do it all today. We're going to probably go through all these slides, but we're going to spend next week, so it'll be next Thursday, talking about more in-depth tax type things with actual examples. So you guys, the 8th, right? Isn't the 8th next Tuesday? That is the day that's the holiday that you guys kind of get credit for, since Monday's an actual holiday. So anyway, what we're going to do next week is we're going to plug a lot of tax things into TurboTax. You can use whatever you want. I happen to use TurboTax, but there's TaxCut. There's other tax preparation software out there. And it's like anything else in here. Please don't take anything I'm saying, especially, like that guy's videos or other stuff. I'm not advocating for any particular company, but I am saying that type of software is pretty handy, whether it's TurboTax or somebody else. Because, for example, if I want to see my taxes, and we talked about keeping records last week, I can go back on TurboTax. I've been using it for a number of years, and I'm sure all the companies will do this, H&R and the rest of them. But you can go back there and you can look at your old taxes, and then all that drudgery of filling out your taxes. Most of those forms are already pre-filled, because unless you've moved, your Social Security number hasn't changed, your spouse, children, Social Security, that whole scavenger hunt to find everything is usually a little bit easier. And then also, these things also have the ability to automatically import a lot of different things. So again, your time is valuable, and time spent filling out forms and stuff like that is not where you want to spend your time doing taxes. Where you want to spend your time doing taxes is on striving to pay the least possible. And there's nothing unpatriotic or unethical about wanting to pay the least amount of taxes. That is how the tax code is set up. That is the goal. And if you pay the least amount of taxes, guess what? You're probably a good American, because you're doing things that are deemed usually beneficial to society. Not all of it's fair, I'm not saying that. But there's certain things, adopting children, hey, there's a tax credit for that. Buying your own house, having a little stability, there's a tax credit for that. Taking care of things, giving to charity, doing all those kinds of things. It's not a loophole. That is intentional. There are loopholes in there, but one man's loophole is another man's, benefit. And this is, there's nothing really in there by accident. Even things that have been changed around, there still exists for a purpose. I mean, the tax code is malleable. People can change it, and they do. And believe me, I'm not a proponent of it, but again, I don't feel one bit of guilt in paying the least amount possible. And so we'll talk about some of those tools, because depends what you do. If you're a small business, you've got more options in terms of flexibility, in terms of maneuvering your income around to portray it different ways to pay less taxes. If you're working for, say, state government, federal government, military, whatever, you got nowhere to hide it. It is what it is, and you pay here, but you can do certain deductions, on the other side. But on the income side, you can't really change that around. If you're running a small business, you can characterize income as different streams to make it more advantageous for you. Again, within the rules. There's two different things. There's tax evasion, which you will go to jail for. And then there's tax avoidance, which is, that's good fun. That's a goal. So evasion that's what always takes down the big, drug kingpins and stuff, because what they do is they come to these people and they say, you got this big chunk of money, how'd you get it? Show us on your tax forms where you amass these millions and millions of dollars. And they can't. And, so you got millions of dollars, we have no record of you paying taxes, so you evaded taxes. And so it's kind of a clean kill, and that's, a lot of times it's a lot easier than, I'm kind of thinking that way. I finally watched the end of Breaking Bad. I've had that thing out there forever, and I finally got to, whatever, the final one. If you guys haven't watched it, it was a good show. Anyway, but, you know, they're talking millions of dollars, and obviously if they're audited, people are going to jail. So, how you earn and spend money will have a great effect on the taxes. So, I touched on this just a little bit, and I'll spend more time on it later, but this tax deferred. So again, tax deferred, it doesn't mean you're, you know, if you put money in a traditional IRA, a 401k, a 403b, or a TSP, or that will be tax deferred. So tax deferred means that you aren't paying taxes on it today, you're paying taxes on it at some point in the future. In terms of those numbers, you know, yeah, it just refers to a section of the tax code. But for simplicity's sake, a 401k is kind of what we're used to. In terms of, you guys may already be familiar with that. If you're getting paid by, you know, usually a private entity, you will end up a corporation type thing. You'll end up with a 401k. If you're involved in education, you end up with a 403b. And again, it's just a different section of the tax code. So, seeing as I work for the university, I've worked for other folks before, I've got 401ks, 403bs. I haven't seen a whole lot of difference in terms of tax implications. It's all that tax deferred stuff. TSP, most of you will never have any. Anyway, that's part of the federal service or military. Thrift savings plan is what that stands for. In a traditional IRA, there used to just be a whatever individual retirement account out there, and that sufficed, you know, in terms of the definition. But then many years ago, there's a thing called a Roth IRA. Some guy named Roth. Anyway, the difference between a traditional IRA and a Roth IRA is a Roth IRA, you pay taxes on that money when you put it in that Roth IRA, which means that taxes have already been paid on that. So when it comes to retirement time, no further taxes required. You don't get taxed on that. It is tax-free. Not tax-free in retirement. Well, yeah, tax-free in retirement. But this other one, a traditional IRA, you still have that. Taxes must be paid on at some point. Home mortgage interest deduction. So, you know, there used to be all sorts of interest deductions, and again, you know, the federal government views that as they're losing money. Well, it wasn't their money to begin with, but we're not going there. But anyway, they did rein it in, and they said credit cards are no longer tax deductible, consumer interest. So that was a major hit for the credit card companies, but a huge boom for the federal government. But the Realtor Association, those folks are pretty powerful, and if they got rid of the home interest mortgage deduction, it would have catastrophic impact on home prices and everything else, because of the desirability of owning a home and all that. You would see huge upheaval in the market and a huge turnover in whatever politician was associated with repealing that. It's not going to happen anytime soon. And then tax credits versus tax deductions. Just suffice it to say you want a tax credit if you can get it, all things being equal. Tax credit means, you have a $400 tax credit. $400 comes off of your taxes. Tax deduction, no. Tax deduction means it's deducted from your income, but not all your income. Obviously, your income is not 100% taxed. The government doesn't get it all. The government just gets a chunk. So let's say you have $1,000, tax deduction because you gave some stuff. You gave $1,000 to charity or $1,000 worth of whatever to charity. How much is that worth to you in dollars? It is worth like $280 normally. Most people, and it depends on your tax bracket. That's why that number changes. But a lot of us, when you get to be medium, kind of income thing, you'll be in like a 28% tax bracket, which means that after all the deductions, the government gets federal government gets 28% of your, every $100. So $28 of every $100. So $1,000 deduction would be worth about $280. So again, there's more to it than that. Normally the federal government's bite, by the time you get down there, is much less than that, because we'll talk about this in detail as well, where we talk about tax brackets. They don't say, percentage tax. If the government, if say you made $100,000 and there was a 28% tax rate, not a bracket, the government would get, $28,000. It doesn't work that way. The government they have this progressive rate where it's lower at lower incomes. In fact, I got serious trouble with a student last time because she thought I was encouraging people to be on welfare. But the truth is, if you're making, let's say you're a single parent with like 4 kids and you're making like 40, 50 grand, you might be better off not making any because you're excluding yourself from certain programs. I mean, there are certain low income rates where people aren't, that whole notion of paying taxes, it's people are getting more money back than they ever have withheld, at the lower realms. As you start getting up in income, say 50,000, 60,000, your tax rates start going up. So let's say if you're making 40,000, your rate, marginal tax rate might be like 15%, right? And then let's say it changes every year and you have to go into tables to see all this. If you do TurboTax or something, it just spits out a number. But if you still can actually go in the tables and you will see where, say up to 50,000, I'm just pulling these numbers right out of whatever. So, it's 15% tax break. And then they'll say from 50,000 to 70,000, 20% tax break rate. And then from 70,000 to 100,000, say that's a 28% tax rate. So what it means, of that incremental income from, say, a 70,000 to 100,000, you will pay 28% taxes on that, $30,000 chunk. On those lower chunks, you're paying a lower rate. And then when you get up in the high rates, yes.
What's it like when you're selling a house? I know, there's a certain amount of time that people can go by before they sell a house, and then they'll be in a different, tax bracket. Like, you own a house for over 10 years, and you sell it, you have to pay as much taxes on it.
Yeah, I did an example, I guess that was last week, and it's in the slides, but we're mixing apples and oranges when we start talking about what you're saying is when you sell stock, when you sell, antique firearms, when you sell a house, you have a different type of income that's called capital gains, right? What we're talking, this by definition, what I'm talking about here is income tax. So if you sell a house, that's not income. That's capital gains. And you are right that they have short-term and long-term capital gains. And they're characterized differently in taxes. Like if you're a day trader, and we'll talk more about that later. But all I'm talking about right now is income tax. So the fact of major transactions like that, those are outside. I mean, you can't have these windfall income taxes. Like, I had a buddy of mine. He was getting, the post-Desert Storm. He was a prowler guy. He was getting out of the Navy, and he was going to be given a big bonus type thing from, like, almost a severance pay. That is income. That's characterized as income. And so smartly, what he requested, and he and everybody else, they got all their Navy buddies together, and because the Navy, big federal government, they don't care. They wanted to give him this big chunk of cash in November, and these guys said, "Whoa, please, wait till after the first of the year," because these guys were all basically losing their jobs, and so they were making, say, 70 grand being in the Navy at that point, and then they were going to get maybe 100,000 or 200,000 like severance type thing. They didn't want that in the same tax year because they're going to get clobbered. They requested and were allowed to get that postponed into the next tax year. So that would be something you could do. The irony to that thing, it gets even worse because these poor guys, the Navy, they're whatever. I was an Air Force guy, but Navy, in terms of some administration stuff, it kind of bungled the whole thing, and they realized they cut too many people, and so they hadn't yet paid these guys their severance pay, and then they said, you know what, we got rid of too many people. You guys can still go, but we're not giving you as much money anymore. So these guys, I think they fought it. I think they ultimately got their money, but it's just mismanagement because it's such a bureaucracy. But anyway, yeah, I'm not getting political here, but when people say, oh, there's free medical care, there's free, that nothing is free. Somebody's paying for it, whether it's you or it's just, printing more money. But, anyway, a third of each dollar you earn goes to pay taxes. And that's just what happens, yes.
Back to the Roth IRA.
Sure.
Does it make more sense if you have a 401k, $50,000 say, and to put it into a Roth IRA now, as if when the guy like me is not earning income, is going to school, as opposed to put it in like after I start earning money?
Yeah, you know what? In that unique circumstance, that might be the case because your income. A 401k and a traditional IRA is a means to lower your income in the eyes of the federal government when you go to pay taxes. And your tax rate on that Roth IRA, you're in sort of an inverse situation where you're probably in a lower tax bracket than you will be certainly in your prime working life, and even more I would say in your retired life. So that would be, I don't claim to, portray an expert on TV here, but from what we're saying, that seems very, very logical.
Because you're taxed on it right now.
Yeah, the reason why you're doing a 401k and a traditional IRA is to avoid paying those taxes on it right now. But if in your situation, and probably a lot of your situations, the government's not hammering you too bad, then this might be the time to do that. That will change, and also the problem with traditional IRA and Roth IRA are there's limits involved, and we'll talk more about that when we get into them. But my income is such that it's really frustrating to do taxes now. I pay a fortune for my daughter's education down at Auburn, all out of state, all tax deductible. No, because it's all based upon. As you get to a certain income level, they start cutting away all the little scoobies, and so you're kind of stuck. Charitable giving, that's still legitimate, but there's a whole lot of tax benefits and tax programs, and it kind of gets back to my discussion about somebody who's scraping it out. There's a certain level in there, depending on your deductions, where if you make yourself ineligible for certain programs, your health care is falling in the same boat. Right now, things are going to have to adjust. I mean, things are kind of upside down right now because there's things called marriage penalties, and then there's other times where sometimes it pays to be single, sometimes it pays to be married. There are people who will, again, it's not something you'd have to have a pretty understanding relationship, but they will get married and divorced through the tax year. I mean, it's just a legal thing. Married by contract. I mean, they're still married in the spiritual sense, I would imagine. But anyway, for tax benefits, they'll get married and unmarried to fight the tax laws, because it depends. When you go, and that's the beauty of, we'll see this next week, when you go into something like TurboTax, you can check the block, married filing jointly. You can check the block married filing individually. Run the numbers both ways, especially if you've got a screwy situation. The goal is to minimize your tax load. Sometimes you file head of household. And then of course you can always file single, but if you're filing single, it's going to be painful. That is going to push you into the highest bracket, and the deductibility of certain things. Let's say deductibility for the ability to use some of these things cuts off at $100,000. Well, for a married couple, it may cut off at $175. You know what I mean? So you're eligible for more things. For getting back to the housing thing, we talked about that, where your capital gains are excluded $250,000 for a single person, $500 for married people. So there's a lot to that. But yeah, you're in a unique situation. Again, not to get political, but there's a guy, Art Laffer, love him, hate him, whatever. I tend to agree with most things he says in terms of it's only logical, where if you increase tax rates to a certain level, tax rates tend to modify people's behavior, and so
there is a certain point where, like, I guess France has tried to do this, and New York State tries to do this, or we've got a 90% tax rate. Guess what? Nobody pays 90% taxes. They move. Rich people have the ability. These millionaire taxes, they do not work because the people just, you know what? Used to live in France, now I live in the UK. I used to live in New York, now I moved to whatever state. So, there's tax people realize that there's a certain point on that curve where the government gets the maximum amount out of folks, and if it's too low, obviously they're not taking as much as they could have. But if it gets too high, people change their behavior and they spend more time dodging taxes than they do being productive and making money. So anyway, I'm not going to spend a whole lot of time on that, but it's a pretty well understood concept. So, effective tax strategy. Understanding tax rules and regulations can help reduce your tax liability. But this is what I said, pick your program, whatever. It can even be the next year's, because the IRS doesn't really formalize things until sometimes in January, So you have to sort of estimate what's going to happen. And you can get the software and maybe run it with last year's, but it's typically available, and you get out there and make changes. I don't know why I did that, but I don't care. Anyway, but what I'm saying again is that everything is frozen in time. Once the end of the year happens, any coulda, woulda, shoulda, maybe I should have, sold this investment. Maybe I should have, in a business sense, maybe I should have bought more property. I was going to give something more to charity. I need to, get that stuff done now, especially if your income is going to change from year to year. If you're going to have anticipating a very big year the next year, or anticipating not much going on the next year, you will try to, within the limits of legal limits, move that income from one year to another to pay the least amount possible. But you can't do that after the first of the year. So, and then also, be ready for what's about to happen. The other thing with this is you can understand, and I don't mean to, be offensive here, but anybody who says, "Oh, I got a huge tax refund," that's just an indication that you're not good with taxes. I mean, you have, in essence, given the government a free loan for a whole year. If they withhold more, now they get very antsy if you under withhold, but your withholding in your taxes, your refund should be semi-neutral. You shouldn't have to pay very much, nor should you have to, because if you have to pay much, then they'll start assessing penalties. But if you're getting a whopping check back from the government and there's not some weird situation, some one-off situation that year, but if year after year you're getting a big refund, no, your withholding is all screwed up. You are having them withhold more money than they should, and in essence, you're giving the government a free loan of your money for the entire year. So the goal is to have the correct withholding. And how do you do that? You manipulate your exemptions. So you can always claim yourself. You can claim children. You can actually do artificial type things. But anyway, you can. Well, I'm not going there, but people will say they have more kids. When it comes to actual tax time, the truth is the truth, and the tax forms are filled out appropriately. But there are ways to change your withholdings to get your tax withholding properly. If you're a high income kind of guy or a business type thing, you may have to do quarterly filings. So, in that case, you're doing filings throughout the year, and they send you little coupons. But I've seen it both ways. I've gotten the little notices, and again, this is kind of the limfac of TurboTax, which is, and it prints out these things. The IRS is going to be looking at you because you didn't withhold enough. I know it was a one-off deal, so I'm not worried about it. But they'll send me the little stubs to make quarterly payments because that's what the IRS would want. I've never been audited, which is a good thing, but actually your odds of getting audited are pretty small. And mine are probably far worse than yours, though, because I've got some foreign property, which is kind of a flag. They always think anybody with foreign property or foreign accounts has those accounts to hide money from the government. But mine were legitimate because I was, owned foreign property. So, anyway, know the current laws, maintain complete tax records, plan purchases and investments, just like I said, and take advantage of benefits while paying your fair share of taxes. So, you will do that. And again, the income taxes are just one realm of taxes. If you invest this money, you make some money, you're going to be paying capital gains on that. Sales tax, you're fortunate up here not paying it, but most places you're also paying sales tax, federal tax, and then when you go, like to get a building permit or something, your motor vehicle, you're paying taxes continually through all different kinds of streams. So this is what we were talking about a little bit when we're talking about the they're limiting this to income tax. There's capital gains and other things that are not income, but in income, earned income, which is what you think of: wages, salaries, tips. Tips are kind of a funny one, but is anybody a food server or anything like that? How do you have to do your taxes for tips? Yeah, and that's for the federal, yeah. Because some states are really vicious.
We have to take our tips and add it to our hourly.
Yeah, because the government used to just routinely get ripped off on this because people would, be working and making huge amounts of money in tips. What restaurant do you work at? Oh, all right. Cool. I haven't gone there much anymore. They changed their menu a couple of years back, and I just got. There you go. So investment income, dividends, rent from investments. So this shows up, you get a 1099, 1099 hours. You get other types of income, and then passive income. The reason why there's passive income is it usually has to do with liability. If you, like for example, I own a small corporation, an LLC, that I use for my side business. I use that pretty much for liability's sake. If a horse panel comes flying off a truck and goes into a busload of nuns or something, the worst they can do is come after me for the amount of money I have invested in the corporation, because the corporation is viewed as a separate entity. So they can sue the living daylights out of that corporation, but my house is not part of that corporation, so it's secure. With passive income, they'll have investments like that they have a line drawn, and again, I'm not a lawyer, but the passive part is to keep you out of the management realm so that you can't be held liable for those actions. So if you're in a passive investment, you need to remain in that state. You can't get actively involved in management, for example. And then other income, if you go to Las Vegas or whatever and happen to hit it big, or of course win the lottery, something like that, I think that's a 1099-G, because it's usually if you just gambling winnings. But yeah, they if you get $1 million at a casino, you don't necessarily get $1 million. You get they're withholding, and then you file your taxes and maybe get a little bit more depending on where you ended up fitting. But everything comes in there.
What's the percentage that they tax on that kind of stuff?
I'd have to look it up. It's going to end up in your income, and then it's going to move your income bracket up. So yeah, it depends on your bracket. But they're going to withhold a certain amount. I don't know what they would withhold. My guess would be somewhere around 28% or something like that, if not more.
Is that the same for say settlements, medical settlements? That kind of?
I'd have to look at that. Yeah, I will, because the thing with that is, sometimes that's bills that are already incurred, or I guess if it's pain and suffering, there's going to be something, but that would be, a judgment, basically. Alimony awards, I think they would put it in the other income, but I'll confirm it. Yeah. But there's really no something like child support, no, not so much, because that's not, alimony is coming from a spouse to represent income. Child support is not a taxable.
Exclusions are amounts not including gross income, so tax exempt income, other things like that.
There's different things. There's a homework problem that we'll talk about today, or you'll see in there. And sometimes there are, like municipal bonds is one thing, where the income is tax-free, tax-exempt. And so that would be excluded. The deal with that, though, is like, oh, I always want the tax exempt. Well, guess what? It's a competitive market out there. So if a regular bond is going for whatever rate, the interest-free bond is going to be going for a lower rate. And so then you got to do the math, and that's exactly what happens in your homework problem. It gives you a 28% tax rate. 1 minus 28.72. Multiply that by the tax rate, the higher tax rate, and boom, 0.72 times that higher tax rate. It's going to come down to something pretty close to the other rate, and then you're going, okay, this one's 6.9, this one's 6.8. I want that one. But just because it's tax-free doesn't mean it's the preferred investment. It just means you got to do some math to figure it out. Total income affected by tax deferred. So that's exactly what we've been talking about. So 401k, 403b, thrift savings plan, or traditional IRA are all tax deferred. And yours is a perfect example. You have the opportunity to put it in a Roth and be taxed on it now and have it tax-free in retirement, or what most people would be doing when they're out making money would be put it in a traditional one to lower their income now, and then with the understanding or the whatever that they're going to be in a lower tax bracket when they're in retirement.
AGI, adjusted gross income. So all sorts of things come out of this. But again,
there's limits on it. Student loan, tuition fees, deductions. When you get to a certain income level, they'll say, nope, that doesn't apply to you. So it's, our tax system is what they call progressive, where, it's in the lower end, it's almost like a pseudo welfare type thing, where people who aren't paying taxes get refunds back. That's just the way it is. And then people at the top tier, they pay a substantial amount in taxes. And we could talk about that, percentages, but if you are indeed one of the top 1%ers, you are, paying a whole lot of tax. And if we look at proportions, I think you could argue that those people are kind of paying their fair share because they get clobbered pretty well when it comes to taxes. Now, I would argue on some of the hedge fund investments and some of the the sophisticated investments that aren't necessarily available to common folks, they may scoot by, and that's where, even in this election season, they're talking about changing the rules on that to up the tax rates on that. So, AGI, and that's just what they call it, adjusted gross income, and that's the amount that you're going to pay the taxes on. So, when you're paying, when they say you have $100,000 AGI, your real income was, what you saw in your total paycheck, your gross, was probably quite a bit higher than that. There's other things you've done to get that down as low as possible. After, you've taken all those adjustments. So. Again, things like, charitable giving and all that kind of stuff. The goal is to get those come in the deductions, but to get your AGI down. But this will make more sense when I go through on TurboTax, because you can actually see kind of where the numbers are, and we can move stuff around. We can show sort of a model of, you own a house, you don't own a house. You pay, let's say, you're making $100,000 a year, and you decide I'm going to take out, $20,000 to put in a 401k. Does that mean I have $20,000 less to spend that year? No, it really means you got about $15,000, $17,000 less to spend that year. Because if you try to get your arms around that whole $100,000, you would have been taxed on that $20,000 you tried to retain. So your opportunity cost, what you're giving up in terms of spendable income, is somewhat less by being in a lower bracket. So it gets really complex, but that's the beauty of being able to run different scenarios and save them under different files and compare and make changes and look at all your different options.
Some of these things too.
People will count up, okay, yeah, I took the kid to the doctor, I went to the Medi-Clinic, I did this, I did that. Guess what? Unless it's greater than 7.5 of your AGI, your adjusted gross income, it's all for naught. So a lot of times, you'll do the same thing. You'll have all these receipts and you'll plug it all in the computer, and you still see, up in the left corner is where your income tax due is. And you don't want to see that window kind of scroll down. It won't move if you haven't hit 7.5. So, and I hate to say it, 7.5 is hopefully none of you will have that exclusion, because that means you got $7,500 if you're making $100,000. $7,500 worth of medical expenses in a year. That's pretty serious. But kids' braces, a few kids, some other stuff. You could hit there once in a while, but it's nothing I'd want to do on a time. Taxes, mortgage interest, contributions. So again, the taxes. If you're paying state taxes, if you're paying foreign taxes, if you're paying, there's even a sales tax adjustment in there. It doesn't work here in Alaska if we're not paying it. Well, actually, some of the folks again, it's done by the most. Somebody probably lives out in the valley, but even at 3%, it's not that high. Kenai's got sales tax too, correct? But anyway, and then miscellaneous expenses, 2%. So the 2% threshold is achievable by most people. You add up different things, and you could probably get to that 2% window. And this gets into when they file, that there's different forms that you'll hear about, 1040, 1040EZ. Anyway, hopefully most of you will be filing a normal 1040 where you're itemizing deductions. The government has, for lack of a better word, where they just have a standard deduction. Hey, don't worry about itemizing stuff, just let it go. We'll give you this big chunk as a standard deduction. But if you itemize your deductions, and they don't meet that big chunk of money that the government says is allowable, then go ahead and itemize them. It'll make more sense when we show it on the slides. But you probably will want to itemize. If you own a home, you do all those sorts of things, you'll hit a threshold where your itemization is far greater than what they call the standard deduction. Subtract exemptions. So exemptions, like I say, you have, your spouse, qualified dependents. Anyway, that we're trying to get to the proper level for the adjusted gross income. Calculating taxes owed. So this gets into this marginal tax rate. It's not the tax rate, it's a marginal tax rate. Because, let's look at the example. After deductions, a person with 20% tax rate pays 28 cents in taxes for every dollar in that bracket. So, they're assuming this green bracket is, say, the 28% tax rate. Let's say this blue bracket is a 15% tax bracket. This one, whatever. They're going to get progressively higher. The government's take is going to get progressively higher as your income goes up. So, but it doesn't mean all your income is subject to 28%. It just means the income in that bracket. You've done a fair amount of tax stuff before?
Yeah. Take TurboTax.
Yeah.
Talking to my dad about it a lot.
Yeah. Yeah. Well, keep me straight if anything I'm saying is not. Because I see you kind of nodding your head. I'm going, yeah. Average tax rate is, okay, you could figure out an average tax rate, but it's not going to be 20%. It's going to be somewhat lower. You know, you can get, okay, I paid, 20% for this chunk and 25 for this chunk and 28, so my average tax rate is somewhere, mid-20s or whatever. You can figure that out just for curiosity's sake. But anyway, yeah, this is this note I put in here. A large tax refund, that's nothing to be, that's sort of a forced government savings plan that you've sort of adopted. But guess what? It's interest. It doesn't bear a bit of interest. The only way to make this worse is to take a loan on that. Anytime they say instant refund, the government doesn't do anything instant. So if you say, you go and you file your taxes with, I don't know, Jack, or one of these tax people, and you say we're going to give you an instant refund, what they're going to do is they're going to figure out how much you're due in terms of the refund, and you're essentially going to sign over that refund to them, and then they're going to give you a loan for that amount of money at an interest rate. So they're going to give you the money up front, but it's just a loan on the money that's coming to them. When the refund comes due, it comes to them. Has anybody done one of these, instant refund kind of thing? It's just a method of taking a loan, but I wouldn't get a loan from those people from the get-go, and I don't think they're quite upfront about the program where they say that, it's not instant. It's a loan. Tax credits. So I talked a little bit about this, and there you go. So they're using smaller numbers. A tax credit means that you reduce that. If you put some, again, check on this. If you're thinking, what, I'm going to get some solar equipment. First off, look at the tax reg. Find out if the stuff qualifies. Don't go with what the salesman says. Actually, look at the documentation and say, yeah, okay, that will work. I'm going to buy that stuff. And there's a tax credit associated with it. Now, if you're getting money from the government to put this stuff in, it doesn't work both ways. You don't get paid twice. If you do the Alaska housing thing and you haven't put a new heater in your house, you don't get a tax credit for being more energy efficient. You've already been paid for that. But anyway, let's say in the solar example, you put $100 worth of equipment and there's a tax deduction or not a tax credit. I'm not saying there is, but different times there's different programs. If there were a credit, then that means that your taxes paid. If you owed the government, $1,000 in taxes that year, you now owe them $900. Tax deduction, not the same. Tax deduction just means that, just as they show, $100 tax reduction, $28 if you're in the 28% tax bracket. You need to know your tax bracket, but you can calculate it. So there's still some value to it, and certainly with if you got junk, and again, if it's junk, maybe that's not so cool to be giving it away, but if it's, somebody else's treasure, if it's, maybe furniture or something that's truly usable, you go to, Goodwill or whoever, you give that stuff to them, but ask for a receipt. You can always estimate it yourself, but if I was to get audited, I would want, the little slip from the charitable company that has a date and their signature and maybe some sort of assessed value on it, then you're squared away in terms of tax deductibility.
I think that's changed in the last year or two, where there's not a lot of, you don't get a lot back from giving.
It depends on but if it's tax deductible, it's still, that part hasn't changed. But I think they've changed it on some of the cars and some of the other issues. But again, we'll look that up too. We'll see. But what way were they changing it? I mean,
well, like you bring a load of stuff down to Valley Village and drop it off, don't. I mean, it's not even worth getting the table.
Yeah.
I mean, it has to be a huge chunk of money, like $1,000.
Well, depends on. I mean, it's still when you get to, and this is the beauty of doing the taxes yourself to a certain extent, because you kind of learn, and say you give money to church, there's when you have charitable giving, is this in cash or is this in goods? And I mean, I deduct my stuff last year. I always am getting rid of stuff, trying to downsize stuff, and I just because of the nature of being where I'm at, I often will drop it up at the base, but I'll get a receipt from them, and they'll write me a receipt, and I deduct on my taxes. So I don't know what could have changed. Maybe they're more, there should be, if they really wanted to cut down on, not the fraud, but the exaggeration, is where somebody drops off, their old socks and claims, $60 credit or something. Maybe, the IRS could clamp down the rules saying, we need some sort of estimate for this. We need some sort of proof. Because that is kind of sketchy right now. Again, I haven't been audited, so I don't know exactly, when they start cracking the whip and saying, you deducted, $500 for this stuff, what was it? Where is it? Where's the market value of this? So it's still attractive. And you still do see, there's all these charities that will, accept used cars, boats, stuff like that. So we'll look at that. We're going to spend a couple weeks on this. Other tax credits. So credit, much more valuable than deduction, like we said. Foreign taxes, retirement savings, adoption expenses, lifetime learning type things. If you qualify for these, and most of you guys should qualify for a large number of these education-related expenses, and your parents should too. Mortgage interest, energy savings type stuff, elderly and disabled. Again, there's, I think every time, once a year, they ask me if I'm blind yet or not, because there's a deduction for all types of things. There's all kinds of, again, that are societal good type things. If you're getting a lot of tax credits and tax deductions, you're probably doing some things that benefit society. There aren't too many that are malicious. Prepare to federal tax income. So different categories you can file in. Yep. So the head of household, unmarried individual who maintains a household for a child or dependent relative. So that's not a bad thing. And then qualifying widow, just so, in addition to you losing your spouse, that you're not hit with a tax bill because you went to, that would be a foul. Well, guess what? He died on December whatever. You're going to have to file single this year. That would be a huge tax burden. So 2 years they allow you to extend. So, but anyway, these numbers in this marathon and jointly, separately, you can legally do those, and it depends on how you and your spouse are, your ratio of incomes and all that other stuff, and plug the numbers in. Okay, you do that. The kids can only be claimed once, but I'm going to claim the kids. You're not going to claim the kids. There's a lot of kind of horse trading that can be going on when the taxes are paid from the household total. You can look at those different scenarios, and to do this on paper would be super time consuming. To do this on a computer with 2 different files and working out the numbers and coming up with the lowest total taxes, that's fairly easy. Calculations, so filing status, income, you'll get W-2s, you get all these different tax forms at the end of the year. And again, make sure your withholdings are right. If your withholdings are too low, that's going to be bad too. You're going to be hit with a huge tax bill. The IRS is going to be uber upset that you didn't pay what they felt, because now essentially they've given you a free loan, and they're quick to point that out. If you want to withhold too much, they aren't going to say much. But if you feel like you're withholding money that's been owed to them, they will make you start filing quarterly. They'll do all these other things. They'll start assessing penalties. So, adjustments to income, tax computations, tax credits. Other taxes, self-employment, payments, determine if taxes are due, a refund, or owed, sign your return. So you also have different, like my LLC, limited liability corporation. I file that under my personal taxes just for simplicity. But if you had a corporation, you can choose how you want to do a company. If it's a sole proprietorship, then it's going to go under your own taxes. But if you form a different type of corporation, and again, this is just for a small group of people, but there's different ways you could do that. Most people would probably opt to do it the way I'm doing it, where they file it on one combined return. the tax sources and stuff, you have to, there's no easy way to do this. What I usually do is three separate things to, if I've got a question on my taxes. I'll start with Google, and just in sort of general terms, can I still qualify for head of household? What are the limits on that? And you'll see somebody, spouting off and some lawyer or some IRS related type advice thing saying these are the limits. So at least that'll get you pointed to the right thing, and might even reference the appropriate tax law. And then the next thing you want to do is you want to go to something like Ernst & Winnie's tax guide or one of these other things, or even in TurboTax itself. And now you know the appropriate terms, and you kind of look it up, and you look for a more credible answer rather than some dude on a blog on the internet. So now at least you're feeling a little bit better, like what I'm about to do is pretty legal. And then in any of those tax guides or TurboTax or somebody, they're going to give you the IRS publication. And that's what you ultimately got to do. You got to go to the IRS publication, and it's kind of painful because it's all very legalistic, usually, and confirm, because if you get audited, they're going to go by the IRS pub. You're not going to say, well, I heard I could do it. No, that's not going to work. So, but if you start with the IRS pub, it's kind of hopeless, because you're going to get off on a tangent, because they go into such so far down in the weeds on every specific topic that you by the time you get your question answered, you got to start out with the right pub. And so I find that the IRS sites, for example, they've got a phone number, for tax advice. Last year they said, we just don't have time to answer. They flat public statement that they will not answer that. So if you're looking for help there, whatever. The clock's still ticking. Your taxes still need to be done. So that's how I, get answers to tax questions. And you always, and these are the things by doing the taxes early enough in the year going, I wonder if I could do this, I wonder if that's legal. And you'll find some stuff. You'll also find it's the internet. You'll find lots of bad advice or people who, I don't really know, but, and then they'll go on and tell you their opinion. You need something more official, and that's kind of how I do it. So, Ernst & Young's tax guide, big accountancy firm. The internet, that's just too broad a term. I do it in reverse order of what they do. The software preparation, they will generally keep you out of trouble, or at least, you'll go, why isn't that not deductible? And then you look at the IRS rule and say, oh, my income's too high, or I did this wrong. Electronic filing, just about always. I have to always send in a paper copy on mine because it gets, there's some form or whatever. It always says I'm ineligible for electronic filing, but it's fine. I've got a PDF copy, it prints out. I've got a PDF copy saved, and I just mail them that with the check, so that's easy. And okay, so we're gonna stop there at the audit portion. Let me advance up though. I want to show you because we got capital gains and we've got some retirement stuff we're going to talk about. This is the homework. So it's stuff we've already talked about thus far. I just put the problems out here. These are referenced from, I believe, 10th edition. But you're going to do a couple of things here. You're going to go through and look at these numbers, and do it the old-fashioned way to kind of calculate whether you're going to get a refund. And then this one is the one that I'm looking for not just, in fact, on the other question, I've already amended it to say, I'm looking for a percentage. Because, again, people will naively, I'm always going to take the tax-free. Well, no, you got to do the math. You got to, figure out your tax bracket. In this case, we're using 28%, and figure out what the after-tax rate is for that. And like I said, 1 minus 28, 0.28, 0.72 times 10.2, that's going to come up with a number. And which one of these numbers is higher? And that's the one I want. So that's pretty easy. All right? So have a good
good weekend. I guess we won't see you guys again until next Thursday. And, yeah,